Okay, before I start, there's an announcement about next week I want to make, because I don't want to forget about it. Next week, as you know, Monday, we have no class because it's President's Day. Wednesday, we will have class, but it'll be a entire Zoom session. I could make up some professional reason, but it's completely personal. My grandson's birthday is on Tuesday, and he lives in Burbank, so no, I want to be there. So we will have class, but and if you don't have the Zoom link, I'll make sure you get it again. So next week, Wednesday class will be a Zoom class. So if you show up here, I don't care, just open up your laptop and you can, well, I won't be here. Today I want to wrap up risk-free rates, and there's some big issues that I want to deal with because I think we've really mangled the discussion of risk-free rates completely over the last 15 years. Okay? And if you've been listening to CNBC tracking markets, your mind is blown in terms of what drives risk-free rates, what drives interest rates. So I want to start with a question that I get asked repeatedly by people valuing companies. I'm going to reframe the question. You have a Swiss company. And almost every big Swiss company is not just in Switzerland. Why? It's a tiny country, so it's all over the place. So you can put a name if you want, Nestle. It gets revenues, let's say, in multiple parts of the world. 10% of its revenues in Switzerland, 30% of its revenues in euros, 40% in dollars, and 20% in Indian rupees. So it gets its revenues in multiple currencies. Is that unusual? In fact, I would say that's more the rule than the exception for pretty much every company you value. So I have a question about risk-free rates and just risk-free rates. I want a risk-free rate to use in the valuation. I'll give you the choices and you tell me whether this will work for you. I could take the simple average of those rates. How many think that's a good idea? Okay, because I throw Zambia and Kwacha revenue there. At the simple average, it'll get pushed up. How about a weighted average? That sounds kind of sophisticated. I'm weighting. Why not? What's the weighted average temperature today between New York and London? Okay. If I took Celsius in London and Fahrenheit in New York and took a weighted average based on population, based on GDP, it'd still be stupid, right? Because there are two measurement mechanisms. Never average risk-free rates, ever. So now let's get to the actual choices. Should I use the Swiss franc rate because it's a Swiss company? Could, right? How about the lowest of the range? Because the risk-free rate is supposed to be default-free. Didn't we do that with the euro, pick the lowest rate? Why doesn't that work here? Why can't I pick the lowest rate? Nitin? Oh, because there are 4 different currency risk-free rates, right? In the euro, the reason I was able to do it, I took 10 governments, all of which issued bonds in euros, and I picked the lowest rate there. So the lowest doesn't work. Don't try to be conservative. I don't even know what that means in the context of valuation. Pick the highest number. Does anybody want to tell me what the answer should be if I ask you what risk-free rate, Manish?
Just about any risk-free rate as long as the cash flows are in the same currency.
In other words, all you have to ask me is what currency are you estimating the cash flows? And if I choose to estimate it in Swiss francs, I can value Nestle in Swiss francs. If I choose to estimate it in euros, I can value it in euros. If I choose to estimate in US dollars, I can estimate it in dollars. And just give me an intuition, what do you think you will find? You should get exactly the same value. And again, I know this, I'm beating up this temperature analogy, but you can't take a hot day and make it cooler just by restating the temperature in Celsius, right? You can't take a good company and make it a bad company by switching the currency. Currency is a measurement mechanism, nothing more, nothing less. Second issue, and this is again something that became a factor, especially in the, we're also going to talk about historical risk premiums today, equity risk premiums in general. What does that mean? Again, it's nothing fancy. If I ask you what the equity risk premium for the market is, and I'll give you an intuitive way of thinking about it. A lot of people look backwards. They look at historical data. They look at what you'd have earned on stocks versus T-bonds or T-bills last year, 10 years, last 20 years, last 50 years. Let's say you go down that route. Okay. And I ask you to estimate a historical equity risk premium for the US. So now you have to pick over what history, right? Let me give you the choices and you tell me what the number would look like if you use that history and why you might or might not use the number. I could use the last year. What is the equity risk premium last year for the US market? Stocks had a return of 26%. The T-bond rate had a return of about 4%. That's a 22% equity risk premium. If you build that into your valuation as the equity risk premium you'll demand in the future, you will never find a stock to invest in. You think, what went wrong? Nothing, right? It was 1 year. If I take it this last year, what would the historical risk premium look like at the start of last year? The 1 year number. Remember 2022? It was almost a catastrophic year. Your equity risk premium can be zero, it can be negative. In any given year, who knows what the risk premium is? So clearly 1 year will not work. 5 years, that sounds like a long time period, right? I mean, the problem is we think in time, 5 years was a long time ago. Think of what you were doing 5 years ago. But in terms of stock returns, the answer lies in the numbers. How volatile are the numbers? The more volatile a number, and this is generally true, the longer the time period has to be. And stocks are scarily noisy. I'll show you how noisy they are. And you're going to very quickly see why historical risk premiums can get you into trouble, even with 100 years of data. And here's a final point. Let's assume that this year, stocks have a terrible year. I'm not making any predictions. I don't want this tweeted out, the modern forecast collapse of markets. I get blamed for all kinds of things. But let's say this is a really bad year. We started well, but then bottom fell out. Let's say stocks are down 25%. You're computing a historical risk premium using 100 years of history. Now you've added 2024 to your history and it turned out to be a bad year. This is a pure math question. If I had a really bad year for stocks to my historical data, what will I do to my historical risk premium? It'll go down, right? You're saying, so what? End of 2008. When you added 2008, terrible year for stocks, the historical risk premium went down. Now, what are we telling people to do? Use that as your risk premium in valuing companies. And whenever you get a clash between what your stomach is saying and what the numbers are saying, go with your stomach. At the end of a crisis year, take March 2020, 2008, the end of a crisis year, do you feel more worried about the future or less worried about the future? Nobody during a crisis says, I feel great about the future. I'll settle for a lower risk premium. Historical risk premiums have this intuitive problem, which is they'll push in the wrong direction. They lead you to use a low risk premium when in fact you should be demanding a high risk premium. It's the price of risk. And a high risk premium when in a sense things are great and you feel less worried about the future. I'm going to dig a hole for historical risk premiums and bury it deep today. But I want to set the process going. Think, what are you going to replace it with? I'll at least get the process started. I'll at least get the process started today. So let's close up. Let's go back to where we were in the notes, because as I said, I'm going to start with a few issues with the risk-free rates that I want to finish off before we move on. Yeah, in the last session, we talked about how inflation is the wild card. That explains differences in risk-free rates in different currencies. High inflation currencies have high risk-free rates. No. And that's an incredibly useful property to remember too, because once in a while, or more often than you want, you will run into a currency where you cannot estimate a risk-free rate. Why? Because there's no government bond in that currency. Or there is a government bond, like the Vietnamese dong or the Pakistani rupee, where you say, I don't trust that rate. You have no starting point. You can't come up with a risk-free rate. Don't give up. There is a way in which you can get a risk-free rate in a currency in which there's no government bond rate. Let's assume you want to get a risk-free rate in Egyptian pounds. I had a value an Egyptian bank called CIB this 7-8 years ago, and I wanted a risk-free rate in pounds. So I followed my script. I went looking for an Egyptian government bond denominated in Egyptian pounds. I couldn't find any. So here's how I came up with the risk-free rate for Egyptian pounds, and see if this gives you a template on getting a risk-free rate in any currency. I started with the US T-bond rate. Say, that's so parochial. No, guilty as charged. I feel pretty comfortable that is actually a market rate. The T-bond rate was 2%. I'm sorry, the risk-free rate in US dollars is 2%. Now, what causes differences in risk-free rates? Difference in inflation, right? What if I could give you, and we can talk about where you'd get these numbers, the expected inflation in US dollars. Let's say it's 1.5%. And the expected inflation in Egyptian pounds, 15%. The inflation rate in Egypt is 13.5% higher than the US. If you're in a rush to get a risk-free rate, here's all you need to do. Take the T-bond rate, add on the differential inflation, 13.5%. You come up with a risk-free rate in Egyptian pounds of 15.5%. If you want to impress people with your mechanical, control of the details, it's actually, that's an approximation. If you want the correct number, there's a slight compounding effect. All that implies is you take 1 plus the US dollar risk-free rate, and you scale it up by the difference in inflation rates. You see how much that mechanical perfection gave me? 7 basis point difference, 15.57%. But ultimately, it's risk-free rate in one currency plus differential inflation. In fact, at the start of this year, I actually estimated risk-free rates in 160 currencies. Sounds like a lot of work. I went to the IMF. IMF gives you expected inflation for the next 5 years, as well as in the US. I took the T-bond rate and got the risk-free rates in every currency by adding on the differential inflation. Now, of course, the practical question is, how the heck am I going to get expected inflation? It's not last year's inflation, expected inflation. In the US, it's relatively straightforward to get an expected inflation number. Anybody have any ideas? If you wanted an expected inflation rate in the US dollar, and you're sick and tired of economists getting it wrong. After all, they have no money writing behind. They can come up with any number. What is a good estimate of the expected inflation rate? That's last year's inflation. Yes. We're on to something. What do we say the TIPS rate was? It's a US Treasury real interest rate. And what's the other thing I need to bring in? I need to bring in a 10-year T-bond. So if I have a 10-year T-bond and a 10-year TIPS rate, right now it's about 4% and 1.5%. That difference is a market implied expected inflation. You see, how much can I trust it? There are several billions of dollars invested in that money. I trust that a lot more than I would trust some economists getting on CNBC say, I think based on my gut feeling, it's going to be 3.7%. There is so expect inflation in the US dollar is easy. Expected inflation in Egypt is tough. Nobody, when I ask you what the inflation rate is, whatever part of the world you might be in, what the inflation rate is in your part of the world, what do we normally look at? Look at last year's inflation. Okay. In the US, you look at CPI. In other countries, you look at inflation, but for better or worse, in the US, people at least don't think the Bureau of Labor Statistics is playing games. It's a number, they screw up because of basket. But in much of the world, let's face it, the inflation you observe is, in a sense, affected by how the government measures inflation. Now, I know, for instance, Venezuela, they claimed there was no inflation because what they did was they created a basket of goods, all of which the government set prices on. And they said there's no inflation. Look, the prices didn't change. The fact that you could not buy rice or wheat or whatever it was at the price, completely irrelevant. So I'm not suggesting it's easy to do, but here's the consolation prize. You don't have to be right. You just have to be consistent. What I mean by that is whatever inflation you use here to get your risk-free rate will also be the inflation you use when you project out cash flows. So if you underestimate one, you'll also underestimate the other. So make an estimate, move on. This is not the hill you want to die on. So I want to get this right. The other aspect of it, risk-free rates, and we talked about this, they can change over time. Start of 2023 or 2022, when I taught this class, the T-bond rate was 1.51%. And people looked at it and said, that rate looks too low. How do we decide this? When you look at something and say, that looks too low, what are we implicitly also doing? we have some measure of what normal is, right? You're saying, how do we come up with that measure, what a normal risk-free rate is? There's no template. Now, and I'm going to say something that's going to sound odd, but if you can tell me what you think a normal T-bond rate is, I can tell how old you are. If you say normal T-bond rate is like 6%, you've been around way too long. Right? People probably started in the 1980s. There's actually, evidence in empirical finance, in behavioral finance, that your definition of normal is formed between the ages of 30 and 35, based on what you observe. The further away you get from that, the more different the normal is going to be from other people's normal. You see, already I'm pushing back on, does anybody know what a normal rate is? I mean, there were people who started in 2013 who looked at 1.5%. That's pretty normal because they lived in a market where rates were 2.5%. But when you have this view that something looks too low, you know what the urge is going to be, right? I'm going to replace it. I'm going to normalize it. And it's not just you. There were appraisal services. Kroll, for instance, used to be Duff and Phelps, used to publish a book on equity risk premiums. A lot of people in the appraisal business used. They also suggested that people normalize risk-free rates. It's an extraordinarily dumb idea. And here's why. Let's say you decide to normalize risk-free rates. In other words, you take the 1.5% that it's at, at the start of 2022 and replace it with an average over the last 20 years. You can pick whatever you want, and you replace it with 4%. Tell me mechanically what's going to happen. You have a higher risk-free rate, so your discount rates are going to be higher. And if your discount rates are going to be higher, the value you're going to come up with every stock you're going to look at is lower. And you're going to tell me not to buy and instead invest my money in this nice T-bond you found that you claim makes 4%. Good luck with that, because that bond exists only in your mind. The risk-free rate is not like margin, so you can average across time. It is an actual opportunity cost. And guess what? At the start of 2022, if you didn't invest in stocks, you could bitch and moan as much as you wanted about how low the rate was, but that's the rate you'd have earned. Never, ever, ever normalize risk-free rates. It's asking for trouble because you set up a false opportunity that doesn't exist. Now, part of you saying, but will my valuations not blow up? Hold on, because they will not if you're internally consistent. David, at the start of the class, raised an issue that I think, has driven a lot of thinking about interest rates for the last 15 years. I mean, let's face it, interest rates post-2008 look much lower than interest rates pre-2008 until we got to 2023, and 2022 and 2023. And of course, the reason that people give for why rates were low is, David, finish what's the reason you've heard for why rates are low?
Quantitative easing.
Central banks and quantitative easing. Let's play, and this is well worth playing. Let's play a hypothetical game where there were no Federal Reserve, no central bank. Would there still be interest rates in the market? The interest rates predate central banks. They've been around. What are they set by? Demand and supply. You know what drives, let's think of let's call this an intrinsic risk-free rate. You know what drives an interest rate? Expected inflation. As it goes up or down, interest rates should go up. And an expected real interest rate. This is called the Fisher equation. It's what you're taught in Econ 101. So in a world without central banks, interest rates would go up and down, even without the central bank, because inflation goes up and down and real interest rates go up and down. So what I decided to do was reconstruct an intrinsic risk-free rate going back in time. So we can see what the Fed did over the last decade. So each year, it's a very simplistic proxy. I took the inflation rate that year rather than expected inflation. I took the real GDP growth, real interest rates and real GDP growth over. I added the two numbers up. So if you have 2.5% inflation and a 1.75% real GDP growth, 2.5 plus 1.75 is 4.25%. Let's call that my intrinsic risk-free rate. So the red is the inflation, the green is the real GDP growth. And then on that, I superimpose the actual T-bond rate. Before you do anything else, do the two look like they move together? 1970s, interest rates rose. Why? Nothing to do with the Fed. Inflation shot through the roof. Real growth reflected that. You had high interest rates. Let's get to the last 15 years. What do you notice about that graph? First is, we spent a decade where inflation was low and stable, the lowest inflation decade in a century. The average inflation rate was about 1.7%. We also had anemic real growth in spite of those. This again is one of those things. The interest rates go down, people are going to, companies are going to invest a lot more. It didn't happen. You have low inflation and low real growth. What's low plus low? Low. The biggest reason rates stayed low was because inflation went down and real. And then that allows you to answer the question, why did rates go up in 2022? One of those has to be changed. Inflation shot up. The real driver of interest rates. Can the central banks affect interest rates in the margin? Yes. More at the short end of the spectrum than the long end. You know what I mean by the short end? Remember, the only rate the Fed sets is the Fed funds rate, an overnight borrowing rate for banks. The rates that are most closely related will tend to be T-bill rates at the very short end, 3-month T-bill rates. And even there, it's not clear who's leading and who's following. I mean, take a look at last year and the year before, because the Fed raised rates, what, 11 times over them, or raised the Fed funds rate? Take a look at what T-bill rates were doing before the Fed did it and afterwards. It seems in every single case, T-bill rates go up in the market and the Fed runs to them. I'm reminded of this story of a rooster called Chanticleer. It's a fable. Chanticleer lives in a farm yard and all the other animals give Chanticleer top billing. Why? Because it seems like every morning he gets up and crows and the sun comes up. And all the farmyard animals believe that Chanticleer is responsible for the sun coming up. And one day, Chanticleer's smartphone doesn't work. He doesn't wake up in time. And the sun comes up anyway. And the other barnyard animals say, you didn't make the sun come up. You just made it look like you were in control. The Fed is like Chanticleer. And and this is something the Fed has to do well. It's got to act like it's driving rates, even though at the margin, they're following the market. So in fact, last year, if you just look at what the Fed did, it raised rates 4 times. What did the T-bond rate do? Absolutely nothing. Start the year at 3.88%, ends the year at 3.88%. What will rates do this year? I know the story is the Fed is going to cut rates, so finish the story. So rates should be lower at the end of the year rather than the beginning. I'll make a prediction. Whether rates are lower or higher will depend very much on what inflation does for the rest of the year and what the economy does. I think this fixation with the Fed is actually very damaging because it means we've lost sight of the fundamentals that drive interest rates. Yes.
And that's not what I guess the Fed's purpose is not to set the interest rate anyway, right? Like control inflation.
The Fed doesn't even know what it's anyway, and it's shifted over time, right?
But
Before the 70s, the Keynesian view of the Fed is the Fed's job was to keep the economy going. Then inflation hit. The Fed's purpose then became keeping inflation targeted. We're in a period where the Fed is not sure what it's supposed to do. And that's not a good place to be. But here's what I want the Fed to do. Just stop talking. Okay? And I want the rest of the world to stop talking about the Fed. Because I think we're not discussing the things that truly matter, which is inflation and real growth. But it makes investors feel more secure to think the Fed. Do you know that the Federal Reserve, they have a tour that you can go on. It's like it's a fun tour. The best part is they take you down to the basement. You can see all the cement. You can see the cat. Don't try to do anything stupid. It's secure. Right? I remember taking my middle 2 kids. I think the oldest had gone off to college. My youngest was too young. Middle 2 kids to the Fed for the Fed tour. This was about 10 years ago. I almost made myself persona non grata right at the start of the tour. Because you walk in, it was like 9 o'clock in the morning. The tour guide comes up, very nice 23-year-old. And I almost asked the question, can you take me to the interest rate room? Because if you listen to CNBC, you're convinced that Jerome Powell comes into the Fed And he has this room where he moves things around. I like the T-bond rate looks a little low. Let me move that up a little bit. Now, the Fed controls one very simplistic rate, an overnight bank borrowing rate. The power of the Fed comes from the perception that it has power. And if that perception fades, God help central bank. Look at the Japanese central bank. It's become completely ineffective because after 40 years, people say, this bank has no effect on it. It's like Chanticleer, post-alarm failing, because they've seen the reality. And I think we need to kind of step back from this brink, less focus on FOMC meetings, more focus on how are the fundamentals that drive interest rate. David, did I answer your question?
Yes, but isn't that a bit too theoretical? Because nowadays.
It is the ultimate, because you look at the numbers. It is the ultimate practical number, right?
But what I'm saying is investors nowadays, like when there's a Fed announcement, that moves the markets like
Don't
crazy.
make assertions into facts, right? Interest rates last year, the Fed raised rates 4 times. What did the market do? It was up 26%, right? So in a sense, for every example you can give, I can give a counterexample. You're saying, what about the year before? The year before, stocks were down. Not because the Fed moved 7 times, but because inflation started the year at nothing and ended the year at double digits. The real driver. I mean, at the margin, the Fed can influence rates. But I think that's all, and that's fine. We can accept that. It can influence rates. Stock prices might move based on the influence. The Fed does have access to real economic data that none of us does. So sometimes there's a signaling effect. But beyond that, there's not much a Fed can do, or any central bank. Now, of course, what I said about normalizing rates when rates are low becomes even more potent when you have negative interest rates. Remember, the Swiss franc rate was negative. And there the impulse was, we can't deal with negative rates. Let's make them positive. Let's normalize. For the moment, I'm going to give you the same advice I did with low rates. Leave it alone. Negative interest rates, fine. It will mean that your cost of capital. Later in this class, I will show you a valuation of Heineken that I did in September of 2019 when the euro risk-free rate was minus 0.5%. It has predictable consequences. The cost of capital for Heineken is less than 5%. See, this is terrible. This is great, low discount rate. But think of the forces that lead to low interest rates. If you think about the fundamentals, what has to be true for rates to be low? One is people expect either really low inflation or worse, deflation. And what about real growth? It has to be low or negative. Negative interest rates and really low interest rates are not good. They're bad. They're a signal of what the future is going to bring to this economy. And it should be no coincidence that Japan has the longest history of low and negative rates. It's got a demographic time bomb that's already gone off, and that's reflected in the risk-free rate. So when I estimate the growth and cash flows for Heineken, those same forces that keep rates low will also keep my cash flows lower, my growth rates leveled off. And it means that what one hand gives you, the other hand will take away. I actually think we're in a better place today in terms of valuation with 4% T-bond rates than we were 2 years ago at 1.5% rates. I feel more room to make judgments about companies that are upbeat and positive now than I did 2 years ago. So remember, you're the one estimating the discount rates and the cash flows. As long as you remember what currency you did the discount rate and what goes into that risk-free rate and bring it into your cash flows, it's all going to be okay. Which now brings me to equity risk premiums. I'll give you intuitively what an equity risk premium is, and you can already see very quickly why it's going to be a nightmare estimate. The equity risk premium is what you, so I'm talking about you individually, would demand as a premium for investing in equities as a class, as opposed to something risk-free. So the T-bond rate right now is 4%. The question I'm asking is, how much more than 4% would you need to make to invest in equities as a class? So if I went around this room, and I won't do it, but you can think about it, my guess is the numbers I'm going to get are going to be very different. Let's try. How many of you would accept 6% as your expected return on stocks? Anybody for 6%? What are you saying? Too low. How about 8%? Yeah. So you're saying a 4% risk premium, right? 8 minus 4. And as I go up, you're going to see more and more people step in. Are those the least risk averse people in the room or the most risk averse people in the room? The people who settle for 8. They're the least risk averse. The less risk averse you are, the lower the premium you'll demand. As you get more risk averse, you're going to demand higher premiums. It's not good or bad. Because you know what drives that risk aversion, right? Part of it is how old you are. As people age, risk premiums tend to go up for lots of different reasons, which is again bad news. If you've got a demographic time bomb going off and your population is aging, you can already see equity risk premiums are going to rise. I shudder to think if the Chinese demographic time bomb goes off, what that will mean for equity risk premiums, not just in China, but around the world. It'll also depend on what sex you are. I know we're on touchy ground here. Young men are much less risk averse than young women. I have three sons and a daughter. I can tell you which ones I would never get in the car with while they were learning how to drive. Yeah. And 3 of them, and you can tell already which. So 3 I would not get in. The only person whose car I would get in when she was learning to drive was my daughter. Something about young male brains and risk-taking don't go together, which creates a problem. If you walk into any trading room anywhere in the world, guess who you're surrounded by? Young men. And then we wonder why we get these fiascos, right? $2 billion mistake, $10 billion mistake. I mean, I wrote half jokingly, but half seriously. Is right after the Societe Generale blow up where you had $3 billion got wiped out by a rogue trader. I said, you know what? There's a simple risk control measure you can adopt. What's the only control on a 22, 23, 25-year-old male in terms of risk taking? His mother. I mean, let's face it, right? So I said, here's what you need to do. Pay $150,000, hire each trader's mother to sit behind the trader, look over his shoulder. What are you doing now? That looks a little risky, right? I mean, it's a lot of money. You say, think of how many trading scandals would be avoided if mothers overlooked. Risk aversion, and risk aversion, some of it you're born with, right? Some of us are born more risk averse than others. Nothing you can do to change it. Maybe this should be part of marriage counseling as well, right? Risk aversion coefficients, how is this going to play out? Because you're going to fight about where your money is going to be invested for the rest of your married lives. So estimating this number is going to be difficult. You say, why not just ask every investor what they did, just like I did here? There are 50 million plus people invested just in the US equity market. Completely impractical. And they keep changing their minds. But every time there's a crisis, your risk premiums are going to change. So for as long as we have had this number, we've had trouble estimating it. And the way most people estimate it is to look backwards. And the market where you have the longest history is the US equity market. In fact, there are a couple of people whose entire living is built around just mining this data set to death. So I'm going to estimate the historical risk premiums for US equities using as much data as I can get. I actually don't use any of these numbers, and I'll explain why, but I update them on my website every year for people who want to use them. The equity risk premium in the US, the historical premium, is a number anywhere from 5 to 13%. I'm so 5 to 12%. It's a pretty big range, right? You're saying, how can they be so different? First, it depends on the slice of history I look at. 10 years, 50 years, 97 years, almost 100 years, very different premiums. Depends on whether I compare to T-bills or T-bonds, short-term or long-term. It even depends on how I compute my average. What does it even mean? If I want to compute an average return over the last 95 years, a simple average is to add up the returns each year for the 95 years and divide by 95. That's an arithmetic average. Alternatively, I can invest $100 at the start of 1928 and look at how much that money would be worth today and compute a compounded average. Sounds like inside statistics, right? But the two can be very different. I'll give you a favorite example to illustrate that difference. Let's assume you buy a stock at 50. Next year it goes to 100. What was your return that first year in percentage terms? 100%. The year after it goes back down to 50. What is the return in year two? Minus 50%. What's your arithmetic average return over the 2 years? 100%. But through the magic of averaging, I'm convincing you that a stock that did nothing actually made you a 25% return. I wasn't cooking the books. Arithmetic averages miss the fact that money earns money as it goes through time. It's accumulate value. You can see the numbers are very different. You're saying, how would I pick? If you force me to pick a historical risk, and I already told you I don't like it, I'm going to go back as far as I can. It's weird because I'm going back to 1928. The Great Depression didn't happen till the year, 2 years after. I'm going back. Was the US equity market very different in 1928? Of course. Different economy. You're saying that is so dangerous. Accept it. But you know why I have to go back that long? Because remember statistics, when you compute an average over a period, the way you compute the standard error for the range is to look at how many years of data you have. And if I go back all the way to 1928, that's the longest I can go, my standard error on my estimate is still 2.14%. So let me put some numbers here. If you force me to pick a number here, I would go back as far as I can. I'd look at T-bonds because my risk-free rate I said in valuation is T-bonds, and I'd use a geometric average because things compound. 5.23%, incredibly precise, second decimal point. But you think about the standard error of 2.14%. Remember enough statistics to give me a range on that? What would the range be on that with 5.23% average, 2.14% standard error? How would I compute the range? What did I do? Plus or minus one standard error. If I want 67% confidence, not a whole lot. 95% confidence plus or minus 2 standard errors. So think about it. Even if I go back to 1928, my equity risk premium is going to be anywhere from 1 to 9%. That's a lot of good that does you in evaluation. And that's with 97 years of history. If I go back 50 years, the standard errors go up. And if I go back 10 years, they become almost all noise. 10-year historical risk premiums are practically worthless. I've seen people use Indian equity risk premiums for the last 15 years. Stop doing that. The standard errors are going to dominate the numbers. They're going to wipe out whatever estimates you have. So when you look at historical risk premiums, which are the default, 95% of valuations use it. First, those numbers are incredibly noisy. Noisy is just a nice way of saying the standard errors are huge, the range is huge, I'm not getting a precise estimate. And the second, and this is a more subtle problem, what's the market I looked at to get these premiums? The US market. What is the most successful equity market in terms of creating market cap of the 20th century? The US market. I've taken the most successful market out there. In statistics, this is called survivorship bias. When you take the most successful market, you're going to overstate the premium because you pick the winner. If I wanted a more reasoned estimate of the historical risk premium, you know what I should do, right? Go back and look at the 20th biggest equity markets in 1928. And Austria would have been up there. Put my money in those markets and then looked at the average across these markets. And guess what? A couple of them, your money would have been completely wiped out. Even if you trust historical risk premiums, you decide to use this from this point on, you know what you're telling me, right? That the future is going to look like the past, and you pick the winner for the next century. Historical risk premiums are just fraught with all kinds of statistical problems. I'm amazed that people build castles on it, but their excuse is, what choice do I have? I'll come back and address that because often that's the excuse. What else can I do? Implicit also in historical risk premiums is this notion of mean reversion. It's kind of a buzzy word, but what does it mean when I say there's mean reversion? Fiona, when you say mean reversion, what do you assume?
Like historically, everything will go back to the mean.
Back to the mean, right? So let's say you sign, I'm trying to think the Verlander as your pitcher this year. Why? Because he has this great ERA over his lifetime. What's the problem though? He's 40 years old. There's going to be no mean reversion if you're changing. No, you could pick the best. Messi playing for Miami is not going to be the Messi of old because You say, what's this got to do with do economies shift over time? Yes. And I think we can, in a pre-2008, I used to have a lot more give on this, where I'd say, okay, you want to use a historical risk premium. 2008 for me was a breaking point because it was a reminder that the world, I needed a reminder 8 years into the new century, say, you're not in the 20th century anymore. This is not a global economy where the US dominates and you have a bunch of satellites. We're in a global economy where you can have different parts of the world carrying the global economy. I think even if you believe historical risk premiums, the statistics, you have a problem, which is structurally the global economy has shifted, which means this historical premium becomes untenable. And God help you, you have to estimate an equity risk premium for a market like Vietnam. Now, let's say you have to value Vinamilk, one of Vietnam's biggest, it's a dairy company. It gets its revenues all over the world, very well run company. So about 6 years ago, I had to value Vinamilk. And just for curiosity, I went and computed a historical risk premium for Vietnam. This is no way you're going back to 1928 then, right? In fact, the Vietnamese equity market did not even get started till this century. I think there was 7 years of kind of, I would say, reliable data. You know what the standard error on that 7 years is going to be? So big that there's no point even computing the historical risk rate. And it's not just Vietnam. You take a market like India, right? You go back, the Sensex has been around forever, but the Sensex in the 1960s was this tiny market dominated by a few family group companies. They weren't even financial service companies because they were all government owned. You look at almost every market around the world, maybe the UK, maybe Japan, every other market, there's either no continuous historical data or you have a historical data in a very different market. Now, so if your Vietnamese company asks you how to estimate a cost of equity, you have two choices. You can ask them to come back in about 93 years. You say, I'll have 100 years of data then to compute a historical risk premium, or you can do something now. I would suggest doing something now because you got to value the company now. So I'm going to give you a process for estimating equity risk premiums in other markets where you start with the US premium. So we'll talk about how to get that nailed down. But the basic idea is I want to get a risk premium for other markets. Here's the simplest way to get an equity risk premium for another market. And I'll call this the state of the art, though it's very low art. This is how investment banks get equity risk premiums for other countries. They start with the US premium, 5, 6%, whatever that is. And then remember that default spread we used to clean up government bond rates? That same default spread comes into play here. That default spread can come from a government bond. It can come from the sovereign CDS market. It can come from your rating. And that's why when we spent time on it, I said, don't spend too much time picking one because as long as you're consistent, it's going to even out. So if you picked a low measure of default spread here, it gave you too high a risk-free rate. But then when you get here, it'll give you a low risk premium, at least things will offset. So the default spread became the starting point. And there are actually most investment banks, you ask them, how do you get the equity risk premium for much of the world? They take the US premium and they add that default spread. So in the case of Brazil, at the start of 2024, their 4.6% is my US premium, and I'll talk about where I got that. But the 3.28% is the default spread based on the rating that I used to get the risk-free rate in reais. That's the first one. So when I first started thinking about country risk in the early 90s, I saw this being done, and I said, that does make sense, but not all the way. Here's why. 3.28% is the default spread I would charge for buying a Brazilian government bond, right? But I'm not thinking about buying a Brazilian government bond. I'm thinking about buying Brazilian equities. So again, intuitively, do you think equities are riskier than government bonds or safer? Yes. Riskier. So to me, it seems like you're understating risk by starting with a spread. Okay? We'll talk about how I deal with that. But in the meanwhile, Goldman had similar qualms. And in the mid-90s, they came up with a second way of estimating equity risk premium, where they said, rather than take the default spread, we're going to focus on equity markets. We know the equity risk premium for the US, so think of it in an algebra problem. If we can somehow come up with measures of riskiness in the equity market in the US and the equity market in Brazil, we should be able to use it. And here's how they came up with a measure of the riskiness. They looked at the historical volatilities in the Bovespa, which is the Brazilian equity index, and in the S&P 500. So think of it again, sixth grade algebra problem. The default spread is, forget about the default spread. The equity risk premium for the US is 4.6%. Let's say the standard deviation in the Bovespa is 30%. The standard deviation in the S&P 500 is 18%. The Bovespa is about what? 1.67 times more volatile than the S&P 500. You're charging 4.6% for the S&P 500. They scaled it up for the additional volatility. And the equity risk premium they'd come up for Brazil would be 7.67%. I must admit, when I saw this, I said, this is pretty neat. Let me try this on every country in the world. And I very quickly ran into a problem. If I use this approach, the equity risk premium for the Ivory Coast is 1%. For Costa Rica is 1.5%, much lower than the US. Think of why. I'm using volatilities in equity indices, right? What drives the volatility of an index? The riskiness of a country, undoubtedly, but for indices to be volatile, there has to be trading. If the trading volume goes to zero, guess what the volatility goes to? Price never changes. The Egyptian market looks incredibly safe. Why? Nobody's trading. The problem with this approach is we're comparing markets with very different liquidities. And when we do this, we're going to understate the equity risk. In fact, all of Africa looks safe with this approach. And if I were Goldman, I would not take this to the next step and say, let's just buy African companies. It's all safe there, because the equity risk premium has just been misset. So starting about 30 years ago, I came up with a cheat. It's very simplistic. Here's what I did. I said, look, I want to stay within the same market. And rather than compare volatilities across markets, I'm going to take the standard deviation of Bovespa, just like Goldman did, but compare it to the standard deviation in the Brazilian government bond. Implicitly, I'm arguing that if one market is illiquid, the other market is also going to be illiquid, which is not a bad assumption. So here's how it would play out. At the start of 2024, yes, go ahead, thanks. Yeah. Oh, we'll talk about that. That's my US premium. You didn't see in the historical premium. So I'll talk about my alternative way of estimating equity risk premiums. That's 4.6%. This month it's 4.5. In about 10 days, I'll give you, So I've set up a dynamic process. We'll talk about that. But you're right, it's coming out of nowhere, but I'll fill in the nowheres. Okay? So I looked up two standard deviation, 30% the Bovespa, which is what Goldman would have as well. But now I looked up the standard deviation, the Brazilian government bond, 20%. So Brazilian equities are 1.5 times more volatile than the Brazilian government bond. The default spread for the bond is 3.28%. Again, it's an algebra problem. The updated spread will now be 4.92%. Why is it higher? Because equities are riskier. You add that to the 4.6%. You come up with an equity risk premium for Brazil of 9.52%. Yes.
In terms of the timing of the standard deviation.
As long as you stay stable, I use 2 years of weekly.
Okay.
Why? Because I'm lazy. Bloomberg's default HVT, which is the symbol you can use for any traded instrument, will give you a historical standard deviation. You can change it 365 days. I said
they should match, right?
They should match,
Okay.
right? Otherwise you get, and the nice thing about matching is if something crazy happened in the last year, it's affecting both, right? So as long as you're matched, you're going to be okay. Yes.
So when you calculate the discount rate, you either apply the default spread on the equity risk premium or the risk-free rate.
I do it always in the equity risk. For me, that's no choice because my risk-free rate has to be risk-free. You bring in the default spread in the risk-free rate. You can't call it a risk-free rate, right? And that's my problem is people in their casualness and saying government bond rates are risk-free are actually double counting risk. Because that rate now includes the default spread. They'll get to this stage and they do this on top. And that's exactly why I think we need to clean up government bond rates before we use them. So I do this twice every year. I've been doing it for 30 years. Okay? I'll give you the start of 2024 numbers. I start with the US premium. Still, I haven't told you where that comes from, but I use this approach called an implied equity risk premium, where I back out from the S&P 500. I'll show you the calculation, 4.6%. That's my base. I take every country in the world and I look to see whether they have a sovereign rating. But 85% of countries do 150 countries. either an S&P or Moody's. I can convert them. I have a rating for each country. If the country is AAA rated, I view it as a mature equity market, and I give it the same equity risk premium as the US. Let me repeat that again. All AAA rated countries get 4.6%. Saying why? Because if they're all mature markets, they have to have roughly the same equity risk premium. Do you see why? Because if they were different, money would flow out of the low risk premium markets, the high ones. And these are markets where effectively money can flow from the US to Germany if in fact people thought a better deal. So every AAA rated country gets a 4.6% premium. Yes.
Isn't that affected by the volume of trading in those countries?
Doesn't matter because ultimately you care about, now we've removed the trading part from the equation. We're just saying we want an equity risk premium. Liquidity shouldn't drive that premium. It's a function of risk that we perceive. So it's a way of cleaning up for liquidity, cleaning up for all the other things that might vary. If you're not AAA rated, then I have my job to do. So let's say you're Ba3 rated. The typical default spread for a Baa3 rated country is 2.2%. Now, what's my next step? If I were doing it the way I did in the previous page, I have to go look up the standard deviation, the equity index, which is easy. But I also have to get a standard deviation in the government bond. And I'm handicapped. Why? Because there are only about, remember, there are only about 40 countries which have government bonds. And among those 40 countries, maybe 5 or 6 have traded bonds. I used to try to do this on a country by country basis, and I'd drive myself crazy. So finally, about 5 years ago, I said, I'm wasting too much time, and I'm getting numbers that are completely all over the place. So what I decided to do was cheat, and this is how I cheated. Rather than take each country and try to get this ratio, I found 2 traded funds. One is an index, an S&P index of emerging market equities. They have a history, daily prices. I looked at the standard deviation in that fund. So that's a standard deviation of equities. There's an ETF, I think, maintained by MSCI. I could give you the exact, you can find it on that Excel spreadsheet, which is an ETF of emerging market government bonds. You see where I'm going to go next, right? I looked up the standard deviation, the emerging market government bonds. So I have 2 standard deviations now for equities and bonds. That ratio at the start of 2024 was 1.34. You're saying, what am I going to do with that? Remember that 2.2% default spread you had? I'm going to multiply it by 1.34. I'm going to come up with a country risk premium, add that on to the 4.6%. And I've got an equity risk premium for your country. No rocket science here. Okay? So this is what the world looked like to me at the start of 2024. Take any part of the world that you're comfortable with. It can be Latin America, it can be Europe, it can be Asia, it can even be North America, though you don't get much. There are only 3 countries here. And look across the region to get a sense of, does that make sense? Let me pick Asia, right? You look across Asia, what's the safest country in the world in terms of equity risk premiums? Oh, Singapore. You say, what happened there? Remember, this is a very, very simplistic. Singapore is the only AAA rated, it's really city-state, but country in Asia. It gets the US equity risk premium. You look across the rest of Asia, you can see that China has come down. It's very close to a mature market in terms of its equity risk premium. And I know some of you saying, but isn't China risky now? It's not percolated into markets or into ratings. So this is a purely rating-based approach. And at the bottom, I have an equity risk premium for Asia. You're saying, how the heck did you come up with an equity risk premium in the entire continent? It's a weighted average of the equity risk premiums of all of the countries in that region, weighted by GDP. Why? Because I shouldn't be weighting Vietnam as much as I weight China, very different economies. I have an equity risk premium for every country that's rated and an equity risk premium by region. Until about 7 years ago, there were about 30 countries that didn't make my list. These were countries that didn't have ratings. Why? Because I'll name some of the countries, and you can see very quickly why they don't have ratings. Syria, North Korea, South Sudan. These are called frontier markets. Markets that are so terrifying that the rating agencies, I'm not going there. And about 7 years ago, I didn't estimate the equity risk premiums of those markets, but about 7 years ago. 7 years ago, I decided that I needed to fill in that gap. What if you have a company that gets half its revenues in Syria and half in Afghanistan? God help you, but I still need an equity risk premium, right? So here's what I did. I looked up this score called political risk. It's a service in Europe that gives countries risk scores. Lower scores indicate riskier countries, higher scores indicate the World Bank has a score. So this is not uncommon. I've used PRS for a long time, so I'm more comfortable with them. I'm not suggesting they're better or worse, but they bring in everything that they learn. So they're actually analysts who track every country, they actually have risk scores for most of these 30 countries. So let's take Syria. Syria's PRS score was 45. It's a risky country. You remember, lower scores are riskier. I went looking for other countries with scores between 45 and 50. You can almost see where I'm going next. I found 6 other countries with scores between 45 and 50. 3 had ratings. And I'd estimated an equity risk premium for those countries. You know what I did? I took the average of those 3. I plugged in as the equity. You're saying that is simplistic. Guilty as charged. If you can come up with a better way of estimating equity risk premiums for North Korea, I would love to hear you out. But until that day, I'm going to stick with the simplistic measure. And basically, no matter where you operate in the world now, I have a number that goes with the risk of those operations that I can use. Any questions? This morning, I got an email from somebody in Guyana. And he said, you got the Guyana equity risk premium all screwed up. And he's right. My Guyana equity risk premium is too low. You know what's happened in Guyana in the last month and a half? Venezuela is threatening to invade Guyana. There's, all kinds of, there's risk rising in the country. You're saying, how come you're not reflecting that? What do you think my answer was?
Yeah.
Because the ratings agencies haven't done it yet. And the one thing I can sell this on is, look, I'm not going to go in there and finesse the ratings, because then I open this door to this. You might not like what's in these tables, but if you have a problem, my response is take it up with Moody's, because I'm just reflecting what the rating. So that is its weakest link. Is the alternative is I could use sovereign CDS scores. But you know what the problem with sovereign CDS scores is? They're available for only 80 countries. I'll have half the world uncovered. And I need this entire page. When I did this, I think 1993, I think it was a fall semester for this class, I did this. It was it's a page I created because people are valuing companies, and they were valuing some companies with foreign exposures, and we needed it for class. So I went through, I created it. Then I said, you know what? Now that it's there, it's not rocket science. Why not put it online? So that was 1993. Today, this is the most widely downloaded data set by far on my website. It gets used from the strangest places. I've kind of given up on it, right? But there's no mystery behind it. There's no intellectual firepower. It reflects, and the reason you need it is these equity risk premiums are going to find their way into your valuation. And I'll give you the 3 broad ways in which you can bring equity risk, this country risk, into your valuation. The first is you can assume that every company in a particular country is equally exposed to that country's risk, right? Every Indian company has Indian country risk. Every Brazilian company is equally exposed. That's, again, standard. Now, that's the way many analysts still value companies, is you tell me we're incorporated, I'll give you the equity risk. Do you think that makes sense? I mean, let's take somebody from India and say, are all Indian companies equally exposed to Indian country risk? Yeah. Why not?
If social lending would be.
Well, let's take the Tata Group. You got TCF, Tata Consulting Services, and you got Tata Motors, Tata Steel, Tata Chemicals, Tata Tea, right? They're all Indian companies. TCS gets less than 7% of its revenues in India. So it's an outsourcing company. Tata Motors gets 70%. It used to be 95% before they bought Jaguar Land Rover. Tata Steel is 90%. You take Brazil. You got Embev, beverage company, gets 70% of its revenues in Brazil. But Embraer gets 5% of its revenues in Brazil, the aircraft company. Never made sense. Because it's not where you're incorporated that drives risk. It's where you do business. The second approach comes up with an equity risk premium, but it assumes that your exposure to that country risk is the same as your exposure to all other risks. Remember, betas measure exposure to interest rate inflation. So if you're a high beta company of discretionary products, lots of fixed costs. So this approach, you bring the country risk into the brackets and you scale it up. Again, you have a choice of which country risk to bring in, right? Just the country you're incorporated in or where you do business. And the third approach, you add finesse. Your argument here is your exposure to country risk is very different from your exposure to all other risk, which might or might not be true, but maybe you have a company, but that's true. You have an oil company, and it's an oil company that the country views as a national resource. Guess what? You have country risk attached to you. Tomorrow's valuation of the week is going to be my Aramco valuation for their IPO. Overnight, a company went public and became the largest market cap company in the world overnight. Never happened before, but it's a unique company. It's 300 million barrels of oil under the ground. That's it. That's the company, right? With the advantage being that you can get the oil out for $5 a barrel. And you can see the country risk there, right? It's standing right in front of you. It's all of the reserves are in Saudi Arabia. You're tied at the hip. There you could argue that your exposure to country risk has to be measured separately from all the other risk. So just as we use beta to measure the exposure to all of the risk, let's create a second measure of risk, a country risk measure. Let's call it lambda. There's a story behind why I called it lambda. It's a measure I concocted, not derived, that requires deep thought. I concocted to capture country risk. But all three, the question you could ask is, where do I get my risk from? And as I said, the default now is to take the country of incorporation, which means all US companies have US equity risk premiums. You could be Coca-Cola and get 60% of revenues from emerging markets. I treat you the same as a company that gets all your revenues. Or I would argue a more sensible way is to take a weighted average, and we can talk about how to weight of where you do business. And there are two ways I can measure how you do business. One is to look at the production side and say, where do you produce stuff, right? Where are your factories? You're a commodity company, where do you extract the commodity? Or I can look at the revenue side. Where do you get your revenues? I'll talk about how to decide between or maybe you can use a combination. You can use both production. But the answer is going to be different for different companies. It's not one template fits all, but you take a weighted average. But essentially, you're trying to come up with an equity risk premium that reflects risk. So I'll give you my preferred weight for many consumer product companies. So at the top, you see Embraer, aircraft company. And here I'm on a little dangerous ground. We'll talk about it. I took their revenues. And they got 97%, this is in 2004, 97% of their revenues in Europe and North America. It's shifted. Embraer now is a lot more aircraft that it's selling to the Middle Eastern airlines. At that time, it's almost mature markets. 3% in Brazil. So on a weighted average basis, their equity risk premium looks just like a US or a European company. The reason I said I'm on shaky ground here is here's what I'm missing when I focus just on revenues. Where does Embraer make all these aircraft? It still makes them all in Brazil. So if Brazil goes to hell in a handbasket, I'm in trouble. So I am probably on dangerous ground. And I'll talk about why we end up with revenues often by default. But in this case, I'm a little queasy about this number. The second is Ember, another Brazilian company. But here I feel completely okay using revenues because it makes beer and beverages where the cost of the drink itself is a tiny. I mean, if you think about a Coca-Cola, when it sells a can of Coke, I don't know what it sells at a grocery store for 75 cents. 4 or 5 cents is actually the production cost. The rest is marketing, etc. So in a sense, I don't care where your factories are. I care about where your revenues are, and I use revenue weights. But I'll give you the honest answers why we often end up using revenue weights. And you're going to run into this when you try to do this for your company. So you want to find out where your company has business. Most of your companies will have a geographic breakdown of revenues. I challenge you, and if you find your company does as well, I'd like to know what the company is because I'd like to use it more often. I challenge you to find the data on where it produces those goods. Most companies are opaque. They don't tell you that. They're not required to. The accounting rules require that you break out geographic revenues. And even when they break it out, it might not be at the level of detail that you would like, or it's a level of detail that you don't like. I'll give you both examples. This is Coca-Cola. It's in 75 countries, but it doesn't break down 75 countries. Why? That's a lot of countries, right? It'll fill in 2 pages of their 10K. So what do? They consolidate the revenues by region. So that's their breakdown. And now do you see why I compute the regional equity risk premiums? There are a lot of companies which will do this at least on a segment of their sales. But beggars can't be choosers. When you look at your company, you will be frustrated sometimes with how they break down revenues. US companies in particular drive me crazy. Because here's how they break out revenues. 72% from the US, 28% from the rest of the world. Come on, guys. The rest of the world is a really big place. Can you start filling in some details? So what I do is I take the 28% rest of the world, I attach a global equity risk premium without the US to it. You're saying, but that's not precise. Hey, you can take whatever you can get. So don't be surprised when that happens. Sometimes the breakdown, you look at it and say, what are you guys even thinking? European companies routinely break out their revenues into what they call EMEA. You know what goes in there? Europe, Middle East, and Africa. What? You've taken a safe continent, you've taken this region of the world where nobody's knowing what's going on, you take the risk, you put them all into one pile. This is malfeasance, if you ask me, in terms of revealing information. But again, you take what you can get. Right? So the revenue weights, I agree. No, there are problems with focusing on revenues, but often you do it because you don't have the information. And there's another reason you pick revenues, even if companies break down things into EBITDA by region or EBIT by region. Revenues can never be negative. Thank God for that. Do you see why a negative number can make your weighting really difficult? What if I told you my EBITDA from Africa is minus 150 million? What are you going to do now? Give Africa a negative weighting? It doesn't work that way, right? So revenue weights might not be perfect, but in a sense, they reflect the reality that most of us have, which is only revenues are broken down and they're always positive. And the question of whether you multiply by the beta, I will leave that judgment to you. Most of the time, I think it makes sense because what drives your exposure to all of the risk also drives that. I'll give you the one group where I don't use revenues, where I look at only where they produce goods, and it's oil companies, commodity companies. And here's why. The way I like to think about country risk is I tell people to think about what keeps managers of that company awake at night. If you're an oil company, it's not where you're going to sell your oil that keeps you awake at night. It's where you get your oil. And luckily, oil companies and other commodity companies will break their revenues down by where they get their revenues. This is actually from Royal Dutch in 2015. And you can see the breakdown of oil and gas production around the world in incredible detail. I took a weighted average of the equity risk premiums. You know what? Royal Dutch looks like an emerging market company. And I'm going to argue that many commodity companies, even though they might be headquartered in Australia or the US, have incredible amounts of emerging market risk because the resources they're pulling out of the ground happen to be in some of the riskiest parts of the world. So you can use revenues, especially with companies where the cost of production is low, and you can see that most of it is coming from other expenses. You can use production and you can even use both. You can decide what weights to attach for your particular company, depending on your company. Yes.
What about companies that do a lot of offshoring?
That's a good question. Is Microsoft exposed to Indian country risk, you think? Remember the old days, even before Microsoft sold stuff in India, much of their software was written in Bangalore. I think that's a production issue, right? Software companies are getting their software written in other parts of the world, then they are exposed to country risk, whether they like it or not. Okay? That does require that you get the information on that. And so in a sense, you might be information constrained, but those are exactly the questions to ask when you think about how risky is my company.
But you typically, for those types of companies, still use revenue as a weighted?
Yeah, because the offshoring, let's say India doesn't work out. You know what Microsoft is going to do? It's going to try to put all those software engineers in a couple of big jets and take them to another part of the world. Cheaper than hiring from scratch. or it's going to move it to the Philippines. I mean, this is the problem with offshoring, especially as you get to lower tech offshoring. It's replaceable, and if it's replaceable, it's not a fundamental challenge to your operating model. If you're offshoring something central to your model, you're a pharmaceutical company, you're offshoring your R&D to another part of the world, then I'm worried, right? Because that might not be as easily movable. So again, ask common sense questions. Is this the kind of company where if that offshoring or whatever it is you're doing blows up, the company goes down with it? Yes.
Along the same lines,
Yeah.
Apple's reliance on manufacturing facilities in China are.
Let's face it, I mean, this is why China risk is not just in China, right? Over the last 20 years, every company has become a Chinese company. Now, whether you like it or not, either in production or revenues. So that's why when people sit around and say, oh, China's going, China's down 30%, the economy is shrinking, and they act like this will have no implications for them. It's absurd, right? You can argue about why it's happening, but of course it'll impact you. You take the second largest economy in the world, an economy that has accounted for half of all global real growth in this century. This is going to be a fundamental shift. I don't think people have got their brains wrapped around what will this mean? No, you can't just slot another country in and say India will take over. It's not that easy, right? So of course there is a big issue. And this was part of the supply chain issue after 2020, right? We suddenly discovered that what people did just to cut costs, including offshoring, was creating supply chains in other parts of the world that you no longer had any control over. And that's what we're trying to bring in. And I think we need to push for more disclosure on the production side, because that has to be factored into valuation. Now, this process of thinking about companies being exposed to risk based on whether they do operations was not something I started off doing. I started off doing what everybody else was doing. Tell me where the company is, I'll use, so much easier, right? You basically incorporate, you look up the equity risk range. And about 20 years ago, I was actually on a flight to Brazil, and we talked about how I went to Brazil every year for about 20 years. It's like 2003, I was going to Brazil to do a valuation seminar. Because you catch red eye from here to Sao Paulo, which couldn't sleep. So I was checking out the slides for the next day that I was going to use. And I was using two companies, Embraer and a company called Embratel, which was the phone company for Brazil. And both Brazilian companies, one got 100% of its revenues in Brazil, and the other got 3% of its revenues in Brazil. And I was treating them as Brazilian companies, giving them the same equity risk. I said, this doesn't make sense. Embraer should be less exposed to Brazil risk. And I said, what if I could come up with a measure of that exposure? And I said, I'll call it lambda. Why? Because attaching a Greek alphabet to something adds a layer of sophistication that makes it sound like a deep thought went into it. But my idea with lambda was just like beta. Lambda 1 means you're as exposed as the average company. Lambda above 1 means you're more exposed. Lambda below 1 means you're less exposed. And then you can bring in everything. You think about offshoring, you can think about production, you can think about revenues, you can think about how much the government thinks about your company. The more you're viewed as a national interest company, the more country risk you're exposed to, right? Because everything. So lambda gave me a chance of saying, let's bring all of that in. But at the end of the process, the question is, what can you actually get information? Easiest, of course, is revenues. Here's an entirely revenue-based lambda. Now, and this is for two Indian companies, Tata Motors and Tata Consulting Services in 2008, 2009. Tata Motors got about 91% of its revenues in India. Tata Consulting Services got about 8%. I looked at what the average Indian company got in revenues in India. It becomes a scalar. And if you divide 91 by 80, you get a lambda 1.14. Tata Motors looks like it's more exposed than the typical Indian company. And Tata Consulting Services looks like it's less exposed. But everything I said about lambda still applies here, right? This is, think of it as the least information needy lambda, but it's also the least attractive lambda because you're not gaining much. So I'll give you another way of thinking about lambdas that kind of draws on how we think about betas. How do we estimate betas? We run a regression of returns on the stock against returns on the market index. What do we get? We get a measure of how sensitive our company is to changes in market risk. That's what a beta measures. What am I trying to measure here? A lambda. I want to measure how sensitive a company is to country risk. So here's what I ran, and with Bloomberg, you can actually set up this regression. I took the returns on Embraer and Embratel, the two companies I talked about. I ran regressions against the Brazilian dollar-denominated bond. Think of what that captures, right? Every time Brazil risk goes up, the rate on that bond goes up, the price of the bond goes down. I wanted to see for every 1% change in that bond, how much did each of these companies move? If you look at Embraer, for every 1% up or down in that bond, Embraer moved only 0.27%. Not very effective because investors said, doesn't matter that much in Brazil. In contrast, Embraer, a 1% move in the country risk caused Embraer to move twice as much. This is all the issues we'll have with betas, right? Standard errors, but at least it gives us a way of thinking about, hey, is there a way of thinking about country risk? And here's the generic way to think about it. If your company is exposed to country risk a lot, small movements in country risk will translate into big shifts in that company's stock price. And that's what you're trying to capture with a lambda. Manish, you had a question? No. Now, can these different ways of thinking about cost of equity give you very different numbers? Absolutely. So here's what I did. I took Embraer and I estimated the expected return / cost of equity using 5 different approaches. Actually, you can bunch them up into two basic. Two of the approaches, I just treated Embraer as a Brazilian company, gave it the Brazilian country risk. Those approaches gave me numbers which were 17% plus. Why? Because Brazil had a lot of country risk then. I'm attaching all of it to Embraer because the other 3 approaches, the only difference is whether I put the number in the beta or outside. And this is why I think this is again, not the hill you want to die on. If you want to treat country risk separately, go ahead. You're going to be within 1% of me. But the real big question is, how do we estimate country risk? I told you that most investors, most analysts still think in where are you incorporated. They're using the 17 to 18%. And what are you doing? You're coming along saying, Embraer is not that risky, using it. So what do you think you're going to find when you do a valuation of Embraer? Everybody else is using 17%, use 10%. You're going to find that the stock is significantly undervalued. So here's my question of faith. Would you buy the stock? You see why you need to hold back, right? If they all stay with the 17% perspective, you're never going to make money, even though, on your deathbed, I can say you are right. Embraer wasn't that risky. Fat lot of good that does you if your stock price doesn't go up. So something has to be a catalyst for investors to wake up and say, oh my God, we were wrong. What could be a catalyst that makes investors wake up, recognize they're being unfair to a company? What do you get every quarter from a company? You get earnings reports, right? And if you're a company that's immune to country risk, your earnings will basically reflect what you're doing as a company. The company, at some point in time, you're hoping, you're praying that'll wake people up. Are you guaranteed? Of course not. But there is an investment strategy here of going into every country, picking a company like Embraer. So it'll be Embraer in Brazil. It might be TCS and Infosys in India. It might be Vinamilk in Vietnam. What are you doing? You're picking a risky country, and you're picking a company in that country that gets most of its revenues outside the country. And then you're buying right after a crisis in that country. You're saying, what if there's no crisis? There's always going to be a crisis in these markets, right? Something is going to trigger it. What happens during a crisis? Everybody sells everything, rushes to the exit doors, especially foreign institutional investors. They're the biggest sheep in this process. They push everything down and you step in, make it a limit buy, because if you give yourself the choice, you will find a reason not to buy. Just put a limit buy on Embraer at 50% below the stock price. And then you have it in your portfolio, hoping and praying that something happens. But at least you got it at a great price. And if nothing else, you can collect the earnings and the cash flows and pat yourself in the back, saying this wasn't that risky an investment. But it's basically something that I want you to start thinking about. In fact, go into 10 emerging markets, make a list of 2 or 3 companies like Embraer. The information is there. You can pull it off their annual reports, percent of revenues, hybrid. And if you flip this portfolio in developed markets, what are you looking for? Not for buys, but for sells. You're going to take companies like Coca-Cola, companies with significant emerging market exposure. And here you're going to focus on them and everybody's buzzed up. And this is a great, globalization is amazing. You're going to sell short on these companies, but here you're going to have an issue, which is your time horizon might not be that long, but again, you're waiting for reality to kick in, which might never happen. I'm at least going to start the process of implied equity risk premiums, because we'll come back and talk about where did that 4.6%, you answer the question, come from. You tell me what you pay for something. Have you given me a sense of what your expected return is going to be? If you want a higher expected return, do you want to pay less or more upfront? You want to pay less to get a higher. So the more you pay upfront, the lower your returns are going to be, right? So if you tell me what you're paying for something, I can reverse engineer from that what your expected returns. We do this in the bond market all the time, right? Remember how you compute the yield to maturity on a bond? What do? You take the price of the bond, you take the coupons and the face value, and you solve for an internal rate of return. What discount rate? We do this all the time in the fixed income market. So when you pay a higher price for the bond, what happens? Yield to maturity goes down, and it's so price and yield to maturity move in opposite directions. Let me take that example and please set up how I think about equity risk premiums. Instead of buying a bond, let's say you bought the S&P 500. Can you do that now? Yeah. You can buy the entire index. Instead of coupons, what do you hope and pray you will get as cash flows? You get dividends, and in the US, increasingly buybacks. And unlike a coupon, which is fixed and known, these you have to estimate, right? But mathematically, it's the same problem. You have the price of the index up front, you have expected cash flows. And unlike a bond, which has a finite maturity, stocks can keep going and going. So at some point in time in the future, you're going to put closure and assume your cash flows continue after that. As a math problem, it looks very similar. Price, cash flows. I'm going to solve for an internal rate of return, much messier than doing it for a bond because you might need a solver function in Excel. But when I do that, I get an expected return on stocks based on what you pay for it. So I'm going to leave you with this page because this is my equity risk premium at the start of 2020. It's the start of a story, but I want the story to be started. Start of 2020, there's where the index was 3,230.78. That's what you paid for stocks. I know what the cash flows were in the last 12 months. So that's my starting point. And here's the weakest link in the model. To get my expected cash flows, I use what analysts are projecting as earnings and growth for the index. Could they be wrong? Absolutely. We'll talk about what they get right and what they get wrong. And at the end of the 5th year, I stop and I assume cash flows continue growing, but they grow at the same rate as the economy. I said, how the heck are you going to estimate it? Here again, my risk-free rate thinking helps me, right? What goes into risk-free rate? Expected inflation plus expected real growth. I set it to the risk-free rate. I solve. There's my equation. Level of index, cash flows. I solve for an IRR. I get 7.12%. At the start of 2020, I don't care what you hoped you would make or prayed you would make, given what you paid for stocks, you'd have expected to earn a return of 7.12%. You subtract out the T-bond rate that day, your expected equity risk means 5.2%. At the start, January 1st of 2020, you didn't know the demon that was coming down the pike at you, right? Because we know what happened in 2020. So when we come back on Wednesday, we're going to talk about the rest of 2020, and we'll go all the way up to the start of 2024. But I want you to start thinking about this implied equity risk premium.
Okay, yeah, I'll